Today on the Purpose-Based Retirement Strategies for Self-Employed Individuals and what makes a better investment, guns or gold.
Welcome to the Purpose-Based Retirement with Certified Financial Planner Practitioner Casey Weade.
It's not how much we make during the good times, it's how much we keep during those really bad times.
Casey leads a team of financial advisors with decades of experience, helping families across the country retire with the confidence they deserve. The Purpose-Based Retirement assigns every dollar you've saved a specific purpose to meet a key retirement need.
Whatever risk you faced, we've got a plan for that.
Stay tuned and learn how you can look forward to a worry-free, purpose-based retirement.
Thanks for joining us. If you are a self-employed person, this program is intended for use. Particularly, that's the case today. I'm Lee Kelso here with Casey Weade, Certified Financial Planner and the President of Howard Bailey Financial. Boy, self-employed people do face some challenges, don't they, when it comes to planning for retirement?
They do face some challenges, and it's something that's often overlooked, I think. They struggle a lot with financial planning because they're just so focused on their business. They have tunnel vision. I think even financial advisors have this. Financial advisors have the same issue. They're handling other people's finances, trying to grow their business and run a business, and they neglect their own finances. Doctors do this, neglecting their own health. And business owners do this as well because they're distracted. They're thinking about other things. They're thinking about growing their business. But what we can do is if we really take care of our own finances, if you take care of your own finances as a business owner, I think you'd be amazed by what can happen in your business. When you have that financial stability and confidence, it really grows throughout your entire organization, provides confidence to your employees and the people you're working with as well.
So what are some of those mistakes that you see people making? You mentioned the tunnel vision issue, but what else is there?
Well, I mean, as far as the tunnel vision goes, I've got a gentleman that I know that started a business, as a family business, probably 25 years ago, and they never had any personal savings. Everything was poured back into that business, and they were constantly living in the stress zone, concerned about what could happen next. They ultimately sold the business for $100 million and made out pretty darn good, but they could have had financial devastation prior to that big payday. And along the way, they could have set themselves up nicely to always know they had something to fall back on, a plan that would work regardless of what happened in the business. They could diversify a little bit more. And that is the big thing that I see in a lot of business owners is this lack of diversification. Everything's going back into the business, which is great. We need to reinvest into our businesses, but we also need to make sure that we're taking care of ourselves and our families at the same time to ensure that we're okay regardless of what happens in the business. We need to diversify into other investments and other businesses, maybe even real estate, where we have multiple streams of income to rely on in case something happens to our main business. We have diversified and provided some security for ourselves. And I also see a lot of business owners letting the tax tail wag the dog, as I like to say, where they're spending money in order to save money. So they're buying a new truck.
You've mentioned this before. Don't get to the end of the year and have your accountant say you need to go buy some hardware.
Sure, they're spending $1 in order to save 20 cents or 40 cents, not really understanding what their taxes are and what that tax burden is. A lot of business owners, because they're paying quarterlies and they're actually paying the man, they're not actually just taking it out of a paycheck. Right. They feel these dollars coming out every single quarter or every single time they file their taxes. They really feel the pain of writing that check, but they actually never sit down to figure out what percentage they're actually paying. And in some instances, I've seen business owners that think they're giving all their money away to the man, and they say, you know what, I don't really want to pay taxes anymore, so I'm not going to run my business as well. I'm going to run it leaner. I'm not going to take anything out of the business. And in reality, sometimes they're only in the 25% effective tax rate, and they would benefit from generating a higher level of business and generating more income. And rather than going out and buying a new piece of equipment, taking a distribution and going and diversifying their portfolio so that they can create more security for themselves and their family.
I get that. So get that big picture, get that under control. So what do I do if I'm going to try to save for retirement as a self-employed person? Is it a Roth? Is it what do I look at?
Yeah, well, sometimes the traditional IRA and the Roth IRA is the right way to go just to get things started, but there are income limits that might become a problem when it comes to contributing to a Roth IRA. There's no income limits for a traditional IRA, but at the same time, you may not be able to stuff enough money into those vehicles in order to really make an impact. And what I find is a lot of business owners, they've been building their business, now they're 10 years into business and they're 5 years out of retirement. So now they go, boy, I need to stuff a bunch of money away. I need to start getting funds out of this company in order to make sure that I'm ultimately going to be able to retire. So where can I go start putting dollars in order to get the biggest tax deduction in the peak of my earning years and start really putting some money away for retirement? And for a lot of people, that might be a SEP IRA, it might be a cash balance plan even, it might be a simple IRA or a 401k or a solo 401k. There's a lot of different options out there for us to start stuffing money away for retirement. We just have to know which one's the right one for us.
So people always talk about that SEP IRA. Tell me more about that and help me understand that.
Well, I think a SEP IRA is probably something that's kind of maybe going to go away. I think the reason a lot of people established SEP IRAs in the past was because, well, maybe I could contribute more to a 401k given my income level, but setting up a solo 401k or a traditional 401k, it just meant too much administrative cost, and it was too cumbersome to go through the annual filings. And those 401ks have become much more easy to establish today, and sometimes with very little, if any, cost even. There's robo-advisors out there that'll set up a 401k for you with nothing up front. So 401ks don't have to be all that expensive to set up and establish today, and you might be able to contribute more to your solo 401k or your 401k than you can to a SEP IRA. A SEP IRA and a 401k are both going to limit you to $55,000 a year that can be contributed to them on an annual basis. But a SEP IRA is 25% of your income. Well, if you make $100,000 a year, that's $25,000. So we can't go to $55,000 with the 401k. You could have $100,000 in income and go all the way up to $55,000 in deductible contributions, and it could be a Roth 401k. So you could get $55,000 a year into a Roth. You might be able to do the same thing with a SEP, but you have to do a conversion. Go from a SEP IRA to a Roth IRA after you make those contributions, kind of like a backdoor Roth, if you will. And if you really want to stuff a bunch of money away for retirement, it's definitely not the simple IRA. I think simple IRAs are probably going to be a thing of the past as well, due to I think simple IRAs today, one, they're restrictive, and a lot of them that I see are very expensive because of the investments that are actually in those vehicles. We used to have a simple IRA program at our company, and it was very expensive. We were able to cut those costs in a fraction by going to a 401k. And in years past, you wouldn't be able to do that. And if you wanted to maybe really want to stuff a bunch of money away for retirement, and you're 2 or 3 years out, 4 or 5 years out, you might want to even look into a cash balance plan. Cash balance plans allow you to stick as much as $300,000 or more on a tax-deferred basis into a retirement plan that you can use for retirement income when you ultimately retire. You just have to work with someone that has all these things at their fingertips and can walk you through which one might be the one for you. Set them up side by side, compare them all, and make sure you're making the best decision.
You also mentioned to me something called private placement life insurance. Now, I've never heard of that. What is that?
Sure. Well, there's other strategies that we can use for business owners. After you've went through some of those more traditional methods, you've done your basic tax management, you've set up your retirement plan, then there's other places that you might want to look into. Once you generate significant income and significant assets, you might look into something like private placement life insurance. We know life insurance is a great tax-free income vehicle and tax-free vehicle. However, there's high commissions, there's potentially high fees and expenses, there's limited investment options. Private placement life insurance is basically setting up your own life insurance policy where you can put any type of vehicle you want into it. There's no commissions, there's no fees and expenses, and it's growing tax-free very flexibly. And this is something that Tony Robbins talked about in one of his books, and it's something a lot of really large wealthy individuals are using for themselves. You can also set up captive insurance agencies to minimize your risk while you're working and ultimately take those dollars out. They're tax deferred and they come out on long-term capital gains rates in the future once you shut down your company. There's non-qualified deferred compensation that I've set up for many of the friends and family that I work with that own businesses. There's a lot of different things that you can do out there, especially I think when you're working with a financial planner that owns his own business and is addressing these same issues in his own financial life. I love sharing with people exactly what I'm doing doing in order to minimize taxes and save for our retirement and minimize risk. That might even be managing your different entities, establishing S Corps and C Corps in order to manage those entities, protect you from risk, and minimize your taxes.
You know, I think that my big takeaway here is there are a lot of choices out there, and it pays to really listen to someone who has your best interest in mind and every single option available to you. So don't be dealing with someone who's just trying to sell a product if that's not the right place for you. And that's why I hope that you'll be one of the next 10 people to pick up the phone right now and call the number on your screen and inquire about a complimentary review of exactly what's going on in your financial life. The Howard Bailey team will meet with you and take a look at taxes, where you might be an opportunity to save there. Is your retirement income well planned? And of course, we just talked about all the options for a self-employed retirement plan. Are there options for you there? The best way you'll know is to pick up the phone and call and ask for an appointment for a complimentary review of what's going on in your retirement plan. You can meet with Casey or a member of the team and start yourself down the path toward a purpose-based retirement. So I hope you'll call now. All right, we're coming right back in a second, and we're going to be talking to viewers, answering your questions, so you stay with us.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
The highest educational achievement for a financial planner is the Certified Financial Planner certification. At Howard Bailey, all of our frontline advisors are CFP practitioners. Certified financial planners have been thoroughly vetted with the right education and experience to coach you through the complexities of your retirement. Getting to retirement, that's really the easy part. Find someone with what it takes to get you through this next stage of your life. Would your financial and retirement affairs benefit from a higher level of insight and care? Call us now to find out. Let me help you create the retirement you dream of. Go to my website and pick one of 3 education options to get started today. Get a copy of one of my retirement planning books, sign up for a purpose-based retirement live event, or go to the Purpose-Based Retirement University. 2 days of college-level retirement planning instruction. With the right education and proper coaching, I believe anyone can create the retirement they dream of. It all begins with one step. Visit thepurposebasedretirement.com.
It is time to answer your questions here on the Purpose-Based Retirement. First over to Antwerp and Jeff. Go ahead.
I don't get an employer match in my 401k. Should I still contribute?
It's a great question, Jeff, and one that everyone should be asking. It depends on a number of different factors. In general, I would say no. And for most people, if you don't get a match inside your 401k, you can provide yourself with more options, more flexibility outside of a 401k, maybe contributing to a Roth IRA for that matter, and getting yourself more flexibility, more protection. I mean, one of the biggest problems with 401ks is you have very few and you're very limited on what type of safe options that you have. You have your stable value fund, you have your money market fund, maybe you have a short-term corporate bond fund, and that's still at risk. So you have very limited options that might pay anything above 1%. You're doing pretty good. And if you get those dollars outside of that account, you might be able to get 3 to 4% fixed rates and shop around and do something that offers a little bit more growth potential on the safe side than what you can get inside your 401k. So outside the 401k, much more flexibility, more options, maybe more protection and more growth potential as well. Now, if we make too much money, we may have to contribute to that 401k. So if you have earnings over certain limits, then you may not have the option to contribute to a retirement plan like a Roth IRA outside of your 401k. So you may have to go to your 401k, for instance, for that tax savings and in order to set some funds aside for tax advantage growth. Now, for someone like myself, I do both. I think it's important to diversify our tax buckets, and I contribute to our 401k, and then I go into other tax-free investment vehicles that I can generate tax-free income for myself that offer me more flexibility and diversification, both from an investment standpoint and tax bucket diversification. Rules change, laws change, so I want different tax buckets that offer me a lot of flexibility as I ultimately step into retirement and over the years. So I think there's a few things for you to think about there as far as what type of vehicle you want to contribute to, and first step is understanding what all those different options are and ultimately if they're right for you. And we have to take into consideration all those different variables. Planning for retirement is like a puzzle, and all these different puzzle pieces have to come together.
Let's get up to Millersburg. And Claudine, what's on your mind?
Hi, Casey. Guns or gold? What's the best bet?
Man, that's a fantastic question, Claudine. I think it depends on what we're trying to plan for here. So are we planning for the end of the world? Are we planning for a doomsday scenario? Or are we just looking for a diversifier for inflation? Both of these might make pretty good inflation-protected assets, especially guns in this day and age with greater and greater regulation that I would expect to see in that world. The guns you have are probably going to appreciate over time, much like potentially gold could appreciate over time too. Your guns might actually end up being more valuable than gold depending on what regulations look like in the future. Now, if we're thinking about inflation protection, I think rather than owning physical gold, you might be better off diversifying a little bit more than that. One of the things that I own is a material selector ETF, where I've got something that's diversifying me not just into precious metals, but also into chemicals and oil, energy, and internationally. You know, we want to look at international investments in countries like Canada, where their growth, or Australia, where their growth is tied to the production of commodities. And so one, it's a great thing to diversify your investments and have some uncorrelated assets like precious metals. However, if we're looking at a doomsday scenario, I vote guns, and better yet, better currency, you might want to look into ammunition. Lee and I had this discussion earlier. You know, if we were going to have a handful of something to trade, I think I could carry around a handful of bullets, maybe 9mm, a lot easier than I could carry around a bar of gold. Yeah. And ultimately, I'm probably a little bit safer because I've got my 9 connected to my side as well, right?
Right, exactly.
Now, if we're going to get gold, we might also be better off if you have a girlfriend or you have a spouse. Maybe you're in a little bit of trouble. You want to pick them up a nice watch or a piece of jewelry. That might have benefits of diversification and also some side benefits as well.
Yeah, and if you're in that doomsday scenario thought line, don't be buying ounce coins, because that's going to be way too much value if all you're trying to do is buy some survival supplies.
Then we're going to have to melt those things down, and it sounds very challenging.
Yep, all right. Interesting question, though. Thanks for that. That's great. Let's get to Chris up in Granger, Indiana. Go ahead, Chris.
Is there any way to avoid paying penalties on my retirement if I want to retire before 59 and a half?
Well, first of all, Chris, congratulations on having the ability to retire 59 and a half. You're in a small group of Americans that might have that option and that ability, and there are things that you can do. For instance, your 401k, prior to separation from service, or something that's part of your 401k, part of that tax law that if you're over the age of 55 and you separate from service, you can take distributions from your 401k without paying any penalties. And I've seen this get people in trouble in the past. We had somebody we worked with a number of years ago whose advisor had advised them to roll over their entire 401k. They were just over the age of 55. He said, you're going to have to start paying 10% penalty taxes. There's no way around it. Every time you take a distribution, you're just going to have to pay the penalties. Well, that wasn't the reality. One, he could have left enough dollars in there, which we often advise people to do if they retire prior to 59 and a half. Let's leave the income that you need inside that 401k to satisfy your income before 59 and a half. We'll roll over the remaining funds. This gentleman had already rolled over all those funds. And so what we were still able to do is we were still able to set up what's called a 72T. And that is a substantially equal periodic payments. Basically, we kept it in a brokerage account, but it was kind of like setting up an annuity where we received substantially equal periodic payments, and that exempted him from paying that 10% penalty. And so we were able to still save him from his situation of paying those ongoing penalties without setting up an annuity, but setting up something that took advantage of tax law to eliminate that 10% penalty, even though he didn't leave those dollars in his 401k.
Oh, very interesting strategy.
Yeah, there's a lot of things I think that we can do when it comes to tax law that we're just not trained on. I mean, as advisors, most advisors, even myself, I was trained on how to sell products and investments, and that's how every advisor gets started. And ultimately, we find, well, this isn't the solution that people are looking for. People want a planner, someone that's going to actually structure a plan and advise them on more than just the next best stock. They want to be structured in such a way that minimizes their taxes, provides an income strategy. These things provide peace of mind to know that we've got our risks mitigated because we've got a real strategy and real plan, not just something else that's been thrown into the mix. But most advisors don't get compensated for tax planning, so it's never done.
So if you'd like to have that type of planning and knowing for sure that, yes, I can retire confidently, comfortably, then I hope you're one of the next 10 people to pick up the phone and call right now and request a complimentary review of just what's going on in your entire retirement portfolio. What kind of fees are you paying that maybe you shouldn't be? Are you most efficient with your taxes as you could possibly be? Do you have a plan for long-term income that you can't outlive? And then how much risk might be hiding in your portfolio? Those are all things that you can have a professional help you think through that maybe you're missing out on right now with the person you're working with currently. So be one of the next 10 people to pick up the phone, call the number on the screen, and request that complimentary review with either Casey or a member of the Howard Bailey team. Get yourself headed toward a purpose-based retirement. All right, here's our question of the day. We hope you get this one right. It has to do with how many baby boomers are turning 65 every minute. Casey has the answer when we come back.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
The highest educational achievement for a financial planner is the Certified Financial Planner certification. At Howard Bailey, all of our frontline advisors are CFP practitioners. Certified financial planners have been thoroughly vetted with the right education and experience to coach you through the complexities of your retirement. Getting to retirement, that's really the easy part. Find someone with what it takes to get you through this next stage of your life. Would your financial and retirement affairs benefit from a higher level of insight and care? Call us now to find out.
Our question of the day put you to the test, asking how many baby boomers are turning 65 every minute. What's the right answer?
Well, Lee, the answer is astonishingly 7. 7 baby boomers are turning 65 every single minute, about 10,000 a month. And as these baby boomers turn 65, maybe this is you, have you started to have that discussion about what types of risks are we going to face that might be unique to what other generations have faced in years past? And what we're going to talk about now are 2 big ones, that is interest rates and market risk. So interest risk and market risk, and what that might mean to your traditional stock and bond investments or your mutual fund portfolio for that matter. The first one is interest rates. We've called this a war on seniors, a war on saviors, a war on retirees, and interest rates, being as low as they are, have been very damaging for the fixed income side of your retirement portfolio, pushing a lot of retirees to take on more and more risk with their retirement savings to generate higher levels of income. And now, if we begin to see interest rates rise as they have in the past, we have another issue that might affect the fixed income side of your portfolio. What we can see from this chart is we are in one of the lowest interest rate environments in history. And if we blow this up and just look at the last 35 plus years, we can see from 1950 through today, and over the last 35 plus years, we've seen interest rates fall. So for most of you that are in this group, as a baby boomer, you've experienced a period of falling interest rates, and that meant bond prices rose during that period of time, and you picked up your coupon payments, and equity prices rose as well. This was a great time to be saving and accumulating for retirement. But if we begin to see this flip, now that we're here and we start to go back to here again, you might find yourself in a whole new pickle, and that would be rising interest rates affecting the bond portion or the fixed income side of your portfolio. If you own bonds today, if you own any fixed income, bond mutual funds, you need to make sure you're understanding the risks that you have, not just the default risk, but the interest rate risk and the price change in those bonds. If we have a 1% increase in interest rates, just a 1% increase in interest rates, a 10-year bond can lose 10% of its value. If we see a 5% increase in interest rates, look all the way to the bottom right-hand corner of your screen, that means a 50% loss in the value of the bond funds that you might hold inside of your portfolio. Understand your interest rate risk, understand the bond duration that you have, and figure out how to limit that risk moving forward. The other side of the coin is the equity prices and the S&P 500 that is held within your portfolio. Large cap U.S. equities might be one of your largest holdings, and from this chart we can see that they've been on one heck of a tear after they recovered from the 2001, 2002, 2003, and 2008 financial crises. We've now put ourselves all the way up here in one of the longest bull markets in history, and it's only a matter of time before we enter another period like we've seen in the early 2000s. You've insured your home, you've insured your car, you've insured your life maybe in case of death, and those risks are minimal in relation to what the risks are when it comes to market risks. The risk that you have of enduring a major financial crisis during retirement is 25%. One of the ways you might want to insure against that is utilizing a bond alternative called a fixed indexed annuity. If we look at this chart, we can see exactly how these vehicles work. This blue line here represents the S&P 500 or the stock market. And as you go up with the market. When the market goes down, you go down with the market. With an indexed annuity, with an annual reset, every year you're going to lock in a portion of the gains that you've experienced throughout that bull market. And then if the market pulls back and goes down, you don't have to endure those losses. You don't see any losses, but you also don't see any gains. And when the market starts to rise again, you're able to participate in those gains without having to make up any losses. If we look at what's happened during some of the most major financial crises in history, and you might say, well, how could that happen again? Well, let's first look at valuations. Currently, our current valuation of the S&P 500 puts us over 33. We're now in the second most expensive market in history, getting pretty darn close to what we've experienced in the past. We're now more expensive than the 1929 crash, the 2007 crash, and we're approaching what we saw during the dot-com bubble. Look at what the loss was from peak to trough following that bull market into the bear market. We saw an 86% loss during the worst market crash in history. The 5-year stock returns were negative 71%. A fixed indexed annuity returned 6.5% over that same period of time, on average returning 13% from peak to trough following the bull market. Would you rather have a positive return or potentially a 30% or more loss in the stock side of your portfolio during those market pullbacks? If we look throughout history, we can go back to 2000 through 2017 and find an investment of $100,000. If we would have put that in the S&P 500, would have turned into $210,000. If you would have put that in a bond fund, that bond fund would have turned into $225,000. Had you had it in a fixed indexed annuity with a 50% participation rate, meaning you received 50% of the gains in the S&P 500 locked in annually with no downside, it would have turned into $230,000, performing better than bonds and equities over the last 17 years. Look into a different strategy. Rather than just investing in bonds and stocks like your grandparents did, that's like looking in the rearview mirror as you drive down I-69. Look for a different strategy that could offer principal protection, market participation, locking in of interest periodically, and no interest rate risk or default risk. These are types of strategies that may or may not be right for you, but they're always worth a discussion when risks are as high as they are today.
And if you'd like to get started on that discussion, I think the first thing to do is to be one of the next 10 people who will pick up the phone and call the number on your screen, because it entitles you to a complimentary review of what's going on your retirement plan, taking a look at income, taxes, fees, and most importantly, risk assessment. How much risk might be hiding in that portfolio? Casey just explained what could be ahead. That's something I hope you want to take advantage of. Pick up the phone and call now and ask for that complimentary review. Meet with Casey or a member of the team and learn more about what's happening in your portfolio. Don't leave yourself at risk. All right, you have a good week, and we will see you next time around on The Purpose-Based Retirement.